Welcome to the deep dive. Today, we're looking at something, well, huge, but kind of hidden. A massive transformation in the global financial system. And the clearest sign, it's this incredible, almost relentless gold rush by central banks. It really makes you question what we think we know.
It certainly does.
So our mission today is to, cut through that noise. We're diving into the new gold order, 2025 central bank gold rush, and the global monetary shift. We want to figure out what's really going on with gold.
Who's buying, who's selling?
Exactly, and why these moves by arguably the most conservative financial players out there tell us so much about, well, the future of global power, and why it matters to you listening.
We've got a lot to draw on official reports, market analyses, some really interesting insights into the geopolitical stuff behind it all.
Yeah, think about it. Central banks, they're not exactly day traders, right?
Not at all.
Yet they're piling into gold in ways that seem to go way beyond just, balancing the books. It hints at something deeper, maybe hidden motives, almost like a quiet financial rearmament.
Okay, so let's start with the scale. The raw data for 2025. Because to really get this, you need to see the sheer amount of gold we're talking about.
Right. Lay it on us.
Well, they kept up this really strong buying into the first half of 2025. Net purchases hit 415.1 metric tons.
415 tons. That's a lot of gold.
It's huge. Think like over 200 cars worth.
Yeah.
That breaks down to 248.6 tons in Q1, and then another 166.5 tons in Q2.
Okay, 166.5 in Q2. Now, I've seen some reports calling that a cooling off, a slowdown. Is that right?
Well, yes and no. I mean, technically, it was down 33% from Q1 and 21% from the same quarter last year.
Right.
But, and this is the crucial bit, even at that slower pace, it's still 41% higher than the average quarterly buying we saw between 2010 and 2021.
41% higher than the average for over a decade. That doesn't sound like cooling off to me.
Exactly. It's more like a new, much higher baseline of demand has been set. It's structurally higher now.
And this happened while gold prices were going through the roof.
Precisely. The average price in Q2 2025 was around US $3,208 an ounce. That's up 40% from the year before.
Wow.
So the fact that central banks were still buying significant net buyers at all-time highs, that tells you something important.
Yeah, it's not about getting a good deal.
No, it's not opportunistic. It screams strategic imperative. There's a deeper reason, something beyond just financial returns.
And this isn't new, is it? This 2025 buying, it fits a pattern.
Oh, absolutely. It extends this multi-year trend. We saw central banks buy over 1,000 tons net in 2022, again in 2023, and again in 2024.
1,000 tons a year for 3 years straight, and now this pace in 2025.
It's a sustained policy shift, not a temporary spike. And look at the World Gold Council's latest survey from 2025.
What did that show?
A record 95% of the central bankers they asked expect global gold reserves overall to increase in the next few years.
95%.
And maybe more telling, 43% expect their own institution to increase its gold holdings. Those are powerful signals about their long-term view.
So who are the main players? Who's doing all this buying?
Okay, if you look at the reported buying, and we'll get to why that distinction matters later, a clear pattern emerges.
Geopolitical, you mean?
Very much so. The buying is heavily concentrated in emerging market and developing economies, especially countries looking for, let's say, strategic independence or aligning with the BRICS Plus group.
Like Poland. I heard they were big buyers.
Poland's been the most aggressive reported buyer recently. They added 68 tons just in the first half of 2025. It's part of this long-term plan they have to get their gold reserves up to 20% of their total reserves. They're holding 515 tons now.
515 tons. Okay. What about China? They always come up in these discussions.
China. Officially, they reported adding 19 tons in the first half. Their declared total is now almost 2,300 tons.
Officially? You sound skeptical.
Well, let's just say there's widespread belief among analysts who track this closely that their actual holdings are significantly higher. We'll dig into that.
Okay. Who else is consistently buying?
We see consistent buying from Kazakhstan. They added 22 tons. Turkey added 11 tons in Q2. Then you've got others popping up. The Czech Republic, India, the Kyrgyz Republic, Qatar, the Philippines. It's a broad trend among a certain group of nations.
Or on the flip side, who's selling?
Selling has been pretty quiet, actually. The biggest reported seller so far this year was Uzbekistan, about 27 tons. Singapore sold 10 tons.
Small amounts, relatively speaking.
Very small. Even Germany sold a tiny amount, just 1 ton. So the picture is really clear. Gold is flowing systematically from, let's call them West-aligned or perhaps more transactional players, towards nations building. well, something different, less reliant on the traditional Western financial system.
It feels like a major turning point.
It is a major turning point, but it's also an acceleration of something that started earlier. This is a complete U-turn from the 90s and early 2000s.
Right, back when Western central banks were actually net sellers of gold, the era of the central bank gold agreements.
Exactly. And those agreements quietly expired in 2019, which was telling. The real pivot point, though, was the 2008 global financial crisis.
That shattered a lot of assumptions.
It shattered faith in the infallibility of the Western system, and it fundamentally reminded everyone why gold is unique. It's the only major reserve asset that doesn't carry someone else's promise, no counterparty risk.
So the buying started then, but now it's turbocharged.
Turbocharged is a good way to put it, driven by new, powerful geopolitical catalysts. Which leads us directly to the real motivations. Forget simple diversification.
Okay, let's get into that. Beyond the numbers, why are they doing this?
This is where it gets really interesting. It's about geopolitics. It's about the future of money.
De-dollarization, is that the main driver?
It's arguably the most physical, tangible evidence of de-dollarization happening right now. Central banks are literally swapping out assets tied to one nation's policies, mostly U.S. treasuries, for a neutral physical asset, gold.
And they're admitting this.
Pretty much. That World Gold Council survey, again, 73% of central bankers expect the U.S. dollar share of global reserves to fall over the next 5 years.
73%. That's a huge consensus among, the ultimate insiders.
It is. And they cite worries about the U.S. fiscal situation, the $35 trillion national debt and unpredictable U.S. trade policies. It's a deliberate move, as analysts at Man Group said, away from dollar exposure because the risks are just seen as too high.
So swapping paper promises for physical gold.
That's the essence of it.
And then came the sanctions on Russia's reserves. That must have sent a shockwave.
Oh, absolutely. Freezing Russia's $300 billion in foreign currency reserves in 2022. That was a watershed moment, a real wake-up call for many nations.
Because it proved those reserves weren't really there.
Exactly. It showed that reserves held in Western systems are conditional. They can be taken away.
Right.
This weaponization of finance, as it's called, spooked a lot of non-aligned countries.
Made them realize their dollar or euro holdings were vulnerable.
Precisely. And we see this in the data. Research from both the ECB and the IMF explicitly links these sanctions to increased gold buying, particularly by countries aligned with China and Russia, starting noticeably in late 2021.
Because gold held in your own vault.
Can't be frozen or seized by someone else? It's the ultimate financial sovereignty tool. The lesson learned was stark. Reserves aren't truly yours if someone else holds the keys.
Which ties into the whole BRICS Plus movement, doesn't it? They seem to be building an alternative system.
They are actively working on it. The expanded BRICS Plus group, now 10 members, including big players like Iran and the UAE, sees gold as the bedrock for an alternative to the dollar system.
Is a gold-backed BRICS currency realistic?
Probably not imminent. There are big hurdles to a single currency like that, but they're taking practical steps.
Like what?
Well, reportedly something like 90% of trade between the core BRICS countries is now settled in their own local currencies.
Bypassing the dollar and SWIFT?
Completely bypassing them. And they're developing things like BRICS Pay to link their national payment systems together.
Yeah.
In this emerging multipolar currency world where there isn't one dominant anchor, gold becomes the natural candidate for the neutral, trusted settlement asset.
The ultimate arbiter of value.
Exactly. There are even reports about BRICS-linked gold vaults possibly being set up in places like Hong Kong or Saudi Arabia, specifically for settling trade.
So these three things, de-dollarization, sanctions proofing, the BRICS strategy, they feed each other.
Absolutely. It's a feedback loop. A de-dollarization flywheel. U.S. actions, like sanctions, push countries to de-dollarize faster. That requires a neutral asset gold.
Which boosts demand for gold.
Right. Which strengthens gold's price and role, making it even more attractive as a diversifier away from the dollar, which speeds up the whole cycle. It's ironic, really.
How so?
U.S. foreign policy actions are, in effect, strengthening the main competitor to the dollar's dominance.
It's fascinating how this contrasts with official statements sometimes. You mentioned the Fed saying sanctions didn't cause a big shift out of dollars.
Yeah, there's this glaring contradiction. The Fed says no notable reallocation, while the ECB and IMF research directly links sanctions to gold buying.
So who's right?
They both might be technically, but looking at different things. The Fed looks at the massive global total of dollar holdings, where shifts are hard to spot initially. The ECB and IMF are looking specifically at the behavior of emerging markets, BRICS plus nations.
The ones feeling vulnerable.
Exactly. They're seeing the clear direction of travel for those countries, even if the global total hasn't drastically changed overnight. The Fed sees the status. The ECB sees the trend among the movers.
Okay, this leads us to something you hinted at earlier, the unreported buying. The official numbers aren't the full picture.
Not even close. This is probably the biggest part of the story and the part the media usually misses. There's a huge shadow market for sovereign gold buying.
A shadow market. How big are we talking?
Think about this. In the first quarter of 2025, based on World Gold Council analysis, comparing total demand to reported purchases, only 22% of central bank buying was officially reported.
Wait, only 22%, so 78% was
78%, roughly 190 tons in just 3 months, vanished into vaults without being declared through official channels.
That's staggering. Is that normal?
It's become the norm. In 2022, about 2/3 was unreported. In 2023, over half. This isn't an accident. It's deliberate.
Stealth financial rearmament, you called it.
That's what it looks like. Hiding your true intentions from the market, from rivals. So the key takeaway here is really profound. The real story isn't the gold being reported, it's the gold that isn't.
How do they even do that? How do they buy so much gold off the radar?
There are a few key ways. One is buying directly from domestic mines.
Using local currency.
Exactly. They pay local miners in their own currency, so it doesn't drain their foreign reserves, it bypasses international markets, and it stays off the official reporting radar. The WGC found over half of central banks do this.
Clever. What else?
Using state-controlled entities. Think state-owned banks or sovereign wealth funds. Countries like China and Russia are widely believed to do this.
So the gold is bought, but it doesn't count as official reserves.
Not initially.
Yeah.
It's held off the books from an IMF perspective, but it's still under state control and can be reclassified later if they choose. That's why analysts think China's real stash might be double what they report.
2,000 tons reported, maybe 4,000 or more in reality?
It's certainly plausible. And then you have a discrete over-the-counter, deals large, private transactions structured to avoid immediate public disclosure.
Okay, that covers unreported buying. But there's another hidden aspect, right? Something about how they value the gold they already have.
Yes, the Gold Revaluation Account, or GRA. This is more sophisticated, less understood, but potentially huge.
Gold revaluation account, what is that?
Okay, imagine a European central bank. They might hold thousands of tons of gold bought decades ago, maybe at $35 an ounce under Bretton Woods.
Pennies compared to today's price.
Exactly. The difference between that historical cost and the current market price represents trillions of dollars in unrealized gains across all central banks. This gain isn't just ignored, it's recorded on their balance sheet in this special account, the GRA.
Okay, so they have this huge paper profit sitting there. What's the catch? What's the hidden motive?
The motive could be crisis preparedness. In a future financial crisis, these massive GRAs could potentially be used as a buffer.
Oh.
To absorb losses on other assets. Think about all those low-yielding government bonds they bought during years of quantitative easing.
Yeah.
If those bonds lose value, the GRA could cushion the blow.
So it shores up their balance sheet.
Or, even more radically, some theories suggest these accounts could, under extreme circumstances, be used to effectively cancel out sovereign debt held by the central bank.
Wow, okay. Are they allowed to do that?
Current EU rules restrict it, but rules can change in a crisis. The point is, it gives them a powerful incentive not just to hold gold, but to want its price to stay high or even go higher.
It explains why European banks stopped selling gold and started bringing it home, repatriating it.
Precisely. They're securing this crucial balance sheet tool for potential future turmoil. Think about the U.S. just revaluing its 8,133 tons from the official $42.22 book value to, say, $3,300 an ounce, would create an instant paper gain of over $850 billion.
It's not just an investment, it's deep financial plumbing. Crisis insurance.
That's a good way to think about it.
So all this buying reported and unreported, what does it do to the gold market itself, the price?
It fundamentally changes the market dynamics. This relentless price-insensitive buying from central banks, absorbing maybe 25–35% of all the new gold mined each year, creates a huge structural support for the price.
A floor under the market.
Kind of like a put option, yeah.
Yeah.
It helps prevent those really deep, nasty price drops we used to see. It's a big reason why gold has held up so well since 2022, even when real interest rates were rising sharply.
Which normally hurts gold, right? That inverse relationship.
Historically, yes. But that relationship seems to be breaking down, or at least weakening. The old models based purely on financial factors like interest rates aren't enough anymore. Geopolitical risk, expressed through central bank buying, is now a dominant factor. Goldman Sachs estimated this demand adds about a 9% premium to the gold price.
And what about supply? Can the miners keep up?
Well, mine production actually hit a record for Q2 in 2025, about 909 tons. But the longer-term picture isn't great for supply growth.
Why not?
Years of underinvestment in exploration means fewer big discoveries. Plus, rising costs, trickier geology, and increasing geopolitical instability in some mining regions all act as constraints.
And what about recycling? People selling old jewelry.
That's the really interesting part. Despite record high prices, recycled gold supply is surprisingly low. It only rose about 4% in Q2 2025.
People aren't selling, even at these prices.
Apparently not in large numbers. It suggests a strong hoarding mentality. People are holding on to their physical gold, maybe expecting even higher prices, or maybe just valuing the security it represents more than the cash they could get.
Which makes the supply situation even tighter.
Exactly. It adds to the squeeze.
You also mentioned something about silver earlier. How does that fit in?
Yes, the gold-to-silver ratio. Central banks buy monetary gold, Tier 1 asset, ultimate reserve. They don't really buy silver, which is seen more as an industrial metal.
So all this official demand is focused on gold.
Right, and this one-sided buying has pushed the ratio of the gold price to the silver price to historically high levels. It was around 90-to-1 in mid-2025.
Meaning gold is 90 times more expensive than silver per ounce. Is that normal?
Historically, it's very high. Many analysts look at that and say silver looks significantly undervalued compared to gold right now. If investment demand were to rotate into silver, or if the ratio just starts to revert to its historical average, silver could potentially outperform gold quite dramatically.
Interesting. Okay, pulling this all together, what does this mean for the average person, the retail investor listening to this? How should they read these signals?
The key is not to see central bank buying as a short-term trading tip. Don't try to time the market based on their moves.
Why not?
Because their motives are different from yours. They seek stability, sovereignty, maybe balance sheet repair, not necessarily immediate profit. They can hold gold at a paper loss forever if needed. You likely can't.
And they buy regardless of price, which is risky for individuals.
Exactly. Chasing them into the market when prices are at all-time highs, like that $3,500 spike in April 2025, could expose you to painful short-term corrections. Remember that 6% pullback shortly after.
Good point. Plus, we don't know what they know, especially about the unreported stuff.
Massive information asymmetry. You're reacting to old, incomplete public data. They're acting on their own real-time plans.
So don't blindly copy them, but what is the signal we should take?
View their actions as a long-term barometer of systemic risk. When the world's most conservative financial institutions are systematically preparing for a world with more currency instability, more sanctions risk, more geopolitical shocks.
It's a signal to maybe check your own financial insurance.
Precisely. The reasons they hold gold, crisis performance, diversification, store value, inflation hedge are the exact same reasons you might consider holding some yourself.
And is the old advice on allocation changing, that traditional 5–10% in precious metals?
Many advisors are now suggesting higher allocations given these structural shifts. Maybe 10–15% is more appropriate in the current environment.
How might that look for different people?
Well, adapting a framework like the one from Gainesville Coins, a conservative investor, maybe 55 plus type of lead 20 point, might stick closer to 5–10%, heavily weighted to physical gold, say 80–20 gold silver, for pure wealth preservation. Someone more balanced, maybe 35–54, could look at that 10–15% range, maybe 70–30 gold silver, using a mix of physical metal for the core holding and perhaps some liquid ETFs for easier rebalancing.
And younger, more aggressive investors?
They might push towards 12–17%, maybe 60–40 gold silver, combining physical, ETFs, and perhaps even some carefully chosen mining stocks for extra leverage, understanding the higher risk.
Got it. Okay, looking ahead then, what's the forecast for the next, say, 12–18 months?
I think we have to expect this elevated central bank buying to continue, probably in that 800 to 1,100 ton per year range, maybe more.
Driven by the same things: geopolitics, U.S. debt worries, BRICS.
Yes, those underlying drivers aren't going away. Geopolitical tensions remain high, U.S. fiscal and trade policy uncertainty persists, and the BRICS Plus agenda is moving forward, all point to continued strategic demand for gold.
And the price, where does that leave the gold price?
That strong institutional bid provides a pretty high floor. I think returning to pre-2022 price levels looks very unlikely.
So upside potential.
Given the central bank demand, the potential for investors to come back into ETFs, plus the general macro backdrop of debt and inflation concerns. Yeah, several major banks are forecasting gold testing the $3,500 to $4,000 per ounce range within 12, 18 months.
$4,000 an ounce. That would be something.
It reflects these new structural realities. And a key thing to watch as a signal.
What's that?
Keep an eye on that gap between the officially reported buying figures and the World Gold Council's estimate of total net demand. If that gap widens.
It means the stealth de-dollarization is accelerating.
Exactly. It's a proxy for how quickly things are shifting under the surface.
Which brings us back to why this story often gets missed by mainstream news. Why don't we hear more about this?
Well, several reasons, I think. First, it's complex.
Yeah, gold revaluation accounts aren't exactly headline material.
Right. The deep drivers, GRAs, shadow buying logistics, the geopolitical calculations, they're nuanced. It's much easier to just say gold is up on inflation fears.
Fits the narrative better.
And there's often an implicit bias, maybe unconscious, towards maintaining confidence in the current dollar system. Reporting aggressively on a fundamental shift away from it could be seen as, well, alarmist, bad for stability.
And they rely on the incomplete official data.
Often, yes. Journalists need accessible data, and the IMF numbers are easy to get. But as we've seen, that's only a fraction of the real picture. Understanding the deeper flows takes real specialization.
So, wrapping up, what's the core message here?
It's that central banks are voting with their vaults. Forget the speeches, watch what they do. Their actions signal a clear, collective loss of confidence in the longevity of the unipolar, dollar-centric financial order.
That's a powerful statement.
For anyone willing to look past the headlines, it's arguably the most important financial story unfolding right now.
An incredible deep dive. We've really unpacked how this gold rush is far more than just diversification. It's this profound strategic realignment, de-dollarization, sanctions proofing, building a new system. It's all happening. So here's a final thought for you, our listener. If the world's most powerful, most conservative financial institutions are actively preparing for a future less reliant on the current system, what does that signal for your own financial planning? For your understanding of the shifts ahead, what does it mean for your own financial insurance? Something to think about. We'll leave it there for this deep dive.